What's up, everybody? Michael and Coco here to do some technical analysis on the financial markets. This right here is called the Market Brief, and we do these videos Monday through Friday. It's where we do technical analysis on multiple indices. We got the Dow Jones, SP 500, the NASDAQ 100. We're going to be looking at the banking index. We look at the 10-year bond, gold, silver. We look at multiple different things to help us decide where the market might be headed next. Today's episode is an important one. Let's get into it. All right, welcome back to the Market Brief. I'm going to first start off here in the KBW Bank Index and kind of talk about what's going on with all of that, some very important news. But quickly to recap what took place in the markets today, the S&P 500 did have its fourth straight trading day down today, which hasn't happened since about February. So not the greatest start for the week, let alone this month altogether is not the greatest. The Dow Jones fell over 500 points, so a pretty significant drop, and we'll be pulling up those charts here in a moment. So a lot of pressure on the overall markets, but there's a bright side to all of it, and we'll take a look to see if that bright side can continue in more bullish momentum, or if we're gonna start seeing more of a pullback. The scary thing going on right now is around the banking sector, and the banking sector is just a huge part of the economy. And we mapped out this BKX. This is the KBW Banking Index. It's compiled of 25 of the largest U.S. institutions. And overall, the banking sector got hit the hardest when we're looking kind of from a macro view here, looking at all the other indices. So the banking index here was down 3.85%. The Dow Jones was only down 1.84% with 500 points gone. Now, why is this important? Well, there was some news that came out from BuzzFeed News. I'm going to put the link in the description below if you want to read it. I'm not going to get too into it, but it was an article regarding the FinCEN files, which there's a lot of fraudulent activity and money laundering taking place within some of the biggest world banks. And this is not a good sign for the banking sector, clearly. And the banking sector got hit hard on this news. Can it recover? Potentially. But when we're looking at it from a technical perspective, and like I said, the FinCEN Files article is linked below. Very interesting article. The BKX index. We used some technical analysis to kind of review what's going on with it just the other day. Symmetrical triangle. It's been going sideways for quite some while, okay? For many weeks. This is the weekly time frame. So all of these candles represent a week of data. It's been going sideways, just complete sideways. And today, with the news around the money laundering and the scare around the banks, we not only saw a gap down, but we closed, I'm gonna put Coco down, but we saw a close below this lower trend line. Now we did see a little bit of a bounce back here towards the end of the day, but ultimately here we closed below the trend line of the symmetrical triangle pattern. That is a very bearish sign. We also closed below the EMA 10. So overall context of this is pretty bearish. We're gonna have to keep an eye on here. Now, because it's such a big portion of the economy, what you got to understand is sometimes when you see pressure in sectors like this, you can see pressure in other indices. So the NASDAQ 100 and many other indices here have been being led by the expansion market cap of these tech stocks. So when you see the NASDAQ up, and all the S&P 500 and all these other indices go up and up, but you're seeing the banking sector get hit hard, what's going to take place here is if we see a continuation to the downside, I don't think that the tech stocks are going to be able to expand any more past where they're already at to make up for this big sector. So even if the tech stocks still kind of capture some ground, the banking stocks and the banking sector could really pull these indices down. Now, if the tech stocks, the FANG stocks, start seeing market caps shrink and you start seeing pullbacks within those, that could be even more of just this combined combustion of downwards momentum in these markets. So what can take place? Well, I was talking about in the previous video, maybe we can see the banking sector kind of close its jaw, and then maybe if you see the tech stocks close down, then they'll catch up with one another. Here, if the banking stocks go down, like I was saying, it's a heavy weight on the economy. And if you see tech stocks kind of just floating around, you might see both of them fall in comparison to close the jaws. You just might see something fall faster than the other. So keep an eye on the banking index. Keep an eye on the financials. It's just an overall very, very important thing. And if we see signs like this, that's not a good start by any means or a good sign for any of the other indices. Now, right below this is the NASDAQ 100, and we're tracking within this channel. This, once again, is on the weekly time frame. We broke below that, and now we're clearly below the 50-period moving average. Now, we saw a little bit of a jump up, but keep in mind there's still resistance up above here, and we will be monitoring it here closely. Let's go look at the S&P 500 now. Okay, so here is the S&P 500, and this is what I mean by the thumbnail, Thor's hammer. And clearly, as you can see, as you know, that was just me joking, obviously, but there's a nice big hammer candle here. What does that mean from a psychological point on this, given the context? Well, we were talking about this channel that the price action was kind of locked within. Then we mentioned that it was pinned between the 50 and the 5 EMA. And now what we saw took place on Friday, we saw it make a low, which was not a good sign, and then we saw continuation to the downside. Not only was it a significant gap down, but we pushed lower into our target area where we could potentially buy the dip. We missed that area by about 10 points, so we didn't quite hit it. But right around that point, the bulls stepped up hard, just a big step up from bringing all the way down here from a low of 32.29 and pushed it all the way to close at 32.81. So that is a good sign for the bulls. It shows that there are still people buying these dips. That could resemble some strength. However, it comes with that big, overarching however, they still have room to make up. So this could be very well a dead cat bounce. We have overhead resistance at 33.30. In order for me to consider this to be back in the bulls' favor, they need to recapture 33.30. They need to recapture the 5 EMA, and they need to recapture the 50 SMA in order for me to say, okay, now it looks like the bulls have their momentum back. As it stands right now, this looks like we can see somewhat of a bounce, but we might very well see some weakness take place shortly thereafter. So we're going to have to monitor this one daily. I've been asked, is it a good time to potentially buy this dip? And at the particular point in time, I was waiting for 3,200 to buy it. There are some good stocks out there that you can potentially buy. I threw in on the community tab and also my Twitter. If you don't follow me there, follow me. I was talking about an Apple play right now, and I did enter into a very small position, but it did overall look pretty strong. And I might play the breakout of a falling wedge there, which might go coincide with the S&P 500 if we just get a little bit of a bounce from this point. But be nimble. Have your stop losses. Monitor your risk, because that's the only thing you're going to have complete control of, especially if the market continues to roll over. Be very careful. This is the Dow Jones on the daily. And this is the rising wedge pattern that we tracked in previous videos. It broke out. And then from a technical standpoint, it came and back tested. That happened. So we saw the back test of this trend line way up here. And now we're seeing a continuation to the downside. Over 500 points down on the Dow, showing some weakness. However, the bulls did, press up a little bit towards the end of the day. So it was looking a lot more bearish intraday. However, they did step back. Now, keep in mind, the 5 EMA needs to be recaptured. The 50 needs to be recaptured. A lot of things need to take place for me to consider this to be more bullish. As of right now, this doesn't look like just a buy the dip moment, because the fact is we need to either see some sideways consolidation or just, some movement back to the upside, and then maybe consolidate sideways to move higher. But as it stands at this particular point in time, we closed below this June spike right here. We're below those moving averages. We broke out of this. This does not look the greatest, and we'll monitor this on a daily basis, Monday through Friday, to check back to see if anything changes. But as of right now, I think the industrials, the Dow Jones, can hit the hardest because they resemble closest to what's going on in the economy. People have been saying it's a V-shaped recovery. Not when you open your doors and look outside. Just from my own personal perspective, when I go out, it seems like a lot more people are on edge, not only about in politics, but it just seems to me like people are more anxious, irritable, and looking at businesses, the small businesses around, a lot of doors are closing down. A lot of places in my area aren't going to be reopening their doors. So when you take all of this into consideration, that's just my small view of where I stand in a small city. Maybe you feel the same way, but if you open your eyes to all of this, there's still a lot of hurt and pain in the economy. And I feel like the Dow Jones is closely going to resemble that because it's an industrial average. I feel like it tracks really well with everything. That, and also the Russell 2000 with the small cap, the small businesses, that can too. But I'm keeping an eye close on this breakdown here of the Dow Jones. Need to be careful with this. Here's the NASDAQ on the daily, we did see a nice run up. We broke beneath that trend line, and now we're below this fib level right here. Now, very interesting. We did gap down. We did recapture some ground to actually make it a positive day, 0.4, so up a little bit. And it bounced right over here by the lower Bollinger Band again. And keep in mind, just like it did here on the run up, it can stay overextended for quite a period of time. And it can do the very same thing right here on the lower Bollinger Band. It can stay overextended to the downside for a long period of time. And even up here, we had, a green day, then a red day, a green, and then a red. So it's not out of the woods yet either. We're below the 50, we're below the 5 EMA. This little bounce right here, to me, resembles a lot of people still stepping in and believing that this is going to be a good buy the dip moment. And it very well may be, but this group of people on the daily could be the ones that are, first to jump in on that speculation that it is a good buy the dip. At this particular point in time, I don't have any clarification here on the daily telling me that this is just a good entry point. I would expect more down here to be a good entry point by the 38.2 fib level. There's a lot of support down there. Clearly it acted as resistance, and it bounced around this channel for quite some time as well. So I'm thinking a little bit lower on the daily for the NASDAQ 100 would be a little bit better of a trade, but we will see. We will see. Here is the VIX, the volatility index for the S&P 500. And you can also pull up the NASDAQ vol, and that picked up some speed today as well for volatility. But we've been monitoring the VIX, and the VIX broke out of this kind of bull flag that we've been monitoring. Shot way up, but then obviously pulled back down into around the trend line. I'm still monitoring this because what we might see here, and this, I just tell you, man, this gap down here is just on my nerves. I feel like it needs to get filled just to clear the path so I can get a better understanding of what might be taking place next. Because even if we see a spike up in volatility, I still feel like that doesn't represent much in the long term. I feel like we need to get this gap filled before volatility really starts picking up. Now, I could be completely wrong, but based on my, little experience that I do have, typically gaps get filled in the VIX. So maybe we might have just broke out here, but we might track sideways to down a little bit to come on to close this gap. And then we might, with this Thor's hammer, quote unquote, the hammer candle on the S&P 500 and other indices, we might see a bounce from this point, and it could be potentially a dead cat bounce. So we might see some volatility to the downside, and then we might make that big move where we can hit our targets, which was about 40 to 45. And even potentially higher after that point if we get some more downwards pressure. I will tell you one thing, we'll be looking at the monthly and weekly timeframes, not in this video, but in ones to come. And the monthly timeframes, even the yearly candles, which I never really look at, but I looked at it recently, and it is no joke. It is pretty darn scary. Here is the CPC, and for those that are new to this chart, we use this as a selling signal and potentially even a buying signal. It's more of just kind of like a warning. It doesn't mean yet you have to get out of all your positions, but what we say is you can hedge your bets, take some profits, or adjust your stop losses as necessary. And how it works is simple. First off, the CPC is the options market, and when it's below 1, it means that the overall market is bullish. When it's above 1, it's more bearish. At least the sentiment. Now the CPC takes in a couple different portions. You have the CPCE and the CPCI. The index, which I don't really look at, is hedge funds, institutions, and they typically use that to hedge their bets. So it's typically above 1. The CPCE, which is more of the equity, is retail traders for the most part, and they're typically bullish. So you see it below 1. Then the CPC, which is the total combined. And what I did was I smoothed it over a 10-day period moving average. And when you see crosses below 0.8, it's just to kind of give you a warning like, hey, watch out because things might change here in the near future. But then when it crosses back above 0.8, that's when we say, okay, that's a sell signal. Start doing what I previously stated. And as you can see, times that it crossed back above, you saw pullbacks, not crashes, but just pullbacks or dips. And we cross right here, and then look down at the chart of the S&P 500. Took a little while to respond, and this is a lagging indicator, so it gives us a little head's notice. And we kind of adjusted it, so we don't do it on the downside, we do it on the cross above. And now we're seeing that pullback to the downside. That could be all there is on this pullback. We were testing around 3,200. That might be all there is, but we will see. So it was an accurate reading. And then we have it down here across above. That was obviously the crash, or went below and then above. That doesn't happen typically. And then, over here when it crossed above, we saw the pullback as well. So not huge pullbacks in all cases, but clearly it gave us some sort of a heads up. That's why I like this indicator so much. Now on the flip side to all of this level right here is 0.95. And 0.95 could resemble a buy signal. So I'm going to be monitoring this 0.95. This is kind of a contrarian indicator, right? So we shot way up here in mid-March, okay? That was kind of the last time that we crossed above it. That doesn't necessarily mean that's the buy signal, okay? The buy signal is represented when it crosses back below that period. And as you can see here, we crossed below it and we saw a nice run up in the S&P 500. We crossed below it right here, continue to see a nice run up. We crossed below it right here, and then from that point, we started seeing a nice run up as well. So yeah, you missed the March bottom, but you still managed, if you follow this buy signal, you still saw a nice ramp up. That's on the flip side of the CPC. It's not when it crosses above, it's when it crosses back below that 95 level when it could represent a good time to start purchasing. So if we get above this, then I'm going to be like, all right, now let's kind of wait here to see, what might be taking place in the near future. Here is the DXY, the Dixie, the US dollar index, and I'm showing you it on TradingView right now because for some reason my chart is not updated in stock charts. It probably just hasn't fully processed yet, which actually kind of bugs me. But the DXY, we saw some upwards momentum. What have we been saying and why have we been saying it? Well, what we've been saying is that we need to keep an eye on this chart. It's an important chart. And we've been saying that if we start seeing the dollar rise up, it's going to apply a lot of pressure on other assets such as the indices, S&P 500, NASDAQ, Dow Jones, etc., Russell, etc., and then also gold and silver. And what we saw today, well, we saw a sea of red take place, and the dollar was the asset that was going up. And we're right now at 93.5. So I said that I'm not more convinced until we get to about 94. And, we came very close to 94 today, still monitoring. We need to see a couple closes above it because that could resemble potentially a change in trend, short-term trend. When I'm looking at this channel, we broke above it, then we get a couple closes about 94. Overall context is still bearish. Don't get me wrong. It's below the 50 period. It's below the 200. Both of them are sloping down. If you zoom out even more, it's in a down channel. So bearish context, but the trade here could be very bullish. And how do you change the trend from bearish to bullish? Well, it starts with how the trades play out. Once trades start becoming bullish and bullish and bullish and bullish, it eventually changes that trend from bearish to bullish. Oh my gosh, that was a lot of words. Here is GLD. This is the gold ETF, and I'm bringing up this because there was something weird also with the continuous contracts here on stock charts. So I'm just looking at the GLD and the SLV, and they coincide with one another. So you can always pull up, gold and match the levels of support. They do go hand in hand very well. And if I find it necessary to bring up the gold continuous contracts or the futures, I will bring them up. But as I see it right now, we saw this huge gap down in gold today. And this area of support, which is right around actually where the candle bounced today, right above 176, that's right where the 50% retracement level is, and it closed right above it. So this area of support, this little area right here is right around the 50% retracement level, the fib level, measured from the breakout to the top. So it held that level. That is a good thing for the bulls. However, we did close below the 50. That's a good thing for the bears. And, we're still within this channel, but we saw some pressure to the downside. I've been saying that I'm going to be buying gold if we get to the lower portion of this channel. So I bought an ounce of gold today, the physical metal. And I also stated that that doesn't mean that it's going to bounce from this point, but why not pick some up because I'm long-term bullish. And if it drops down even lower to around, well, on the price of gold, 1815, 1800, or over here, which would be around 170 down to 164. I'd be buying more then again. But I saw the opportunity, so I picked up a little bit more today. Here is the SLV, and the SLV doesn't look nearly as strong as the GLD. We did break out of this symmetrical triangle here, and we closed below the 50 period moving average on high volume. So we just saw a big thrust to the downside here, and it once again bounced right around the 50% retracement level. So that's a good sign for the bulls that level held, and we saw a little bit of a run up, but we didn't capture back that 50 period moving average. So it's too hard to tell right now if this is a temporary drawback, if we're going to see more pressure to the downside. I'd consider buying silver if we can head lower into this 18 to 1850 range. That's where I'm kind of seeing myself as a buyer. But as I see it right now, it's this was an aggressive move to the downside. And we did see the bulls step up, which is nice towards the end. The last time we saw that here to the 50% retracement level, around that level, was here. And then we saw that snapback, which we talked about in previous videos, an overextended move. Kind of gets back and then we're consolidated. But after this long consolidation, this weekly or daily just sideways action over and over again, it was coiling itself up for a big move. We mentioned this on the last market brief on pretty much everything that we're looking at was just coiling up. It was coiling up. So there was a big move under works and we just didn't know if it was going to be hit to the upside or the downside. And I can tell you here, obviously, it was to the downside. So it's going to be interesting to see how this plays out throughout the week. I'd like to see a recapture of the 50-period moving average. And then that, to me, would be a good thing for the bulls. So we'll monitor this one closely. Bitcoin on the daily. Well, check it out. Looky here. This is why I love technical analysis. We broke out of this bear flag to the upside. Once resistance is broken, especially when it's hitting many different levels of resistance, so it creates a strong resistance right here. You broke above it, and we saw that big ramp up. So we said, okay, well, where's the next area of resistance? We said 11,200. Almost within dollars, I'd say, of hitting our 11,200 resistance, and we couldn't recapture it, and we got hit to the downside, down 4% today. That's a pretty big hit to the downside. And on the weekly time frame, this can start looking like that dead cat bounce that we mentioned on other previous videos. As I see it right now, we're going to have to monitor this one closely. We might see some support right around this, right where it kind of bounced, 10,300 to about 10,100, and that'll be a little bit level of a support. But right now we saw some big pressure to the downside. Now we either got to see it, one, snap back from like kind of a rubber band overextension move and then consolidate, and then I'll be like, okay, that's fine, this could be temporary. But if we start seeing it track sideways a little bit, that could set up itself for another bear flag, and then we'd have to monitor it again. Still, on this particular day, this doesn't look like a buying opportunity at this moment. What I need to see is some sort of strength step up, and right now this looks like a lot of weakness to me. I want to end on this note. I realize that how important it is to have a trading plan. I realized this a long time ago. It's obviously important to have a trading plan, but let me tell you and kind of give you a good reason as to why it's so important to be prepared for these type of moves. The biggest reason is if you are prepared and you have a plan and a goal, you don't need to worry about these type of moves taking place in the market. And I realized today on my Instagram stories, I posted this, I was just out in my backyard after, posting some Twitter stuff and doing my thing, but I got to just relax outside in the backyard and do my other work. And even when the market was taking a nosedive or a hit, I had stop losses in place. I created a plan that if this were to already take place, I'd be okay with it. So I made sure to manage my risk in a way where I'd be okay with a big drop, and I'd be okay with entering in on certain moments or other certain trades on the long position. So have a plan in place, because days like this come around where you see these huge rip downs in the market, and it creates a lot of fear. A lot of different headlines come out. This could not be the end. This is going to, everything's going to come to a crash. And that's very possible. It might. But if you're not prepared for that ahead of time, you find yourself trying to solve for it in the heat of everything that's going on. And I can tell by experience, and you probably felt this before, it doesn't take a genius to know this, but you don't typically make good decisions, especially financial decisions, when you're under the red light, when you're under the pressure. So you step away from the pressure, learn everything that you need to learn, take into consideration before something happens, and plan for it for when it does. That's all I got for you on today's Market Brief. I will be back tomorrow. And before I leave, Coco would like to say one final goodbye here too as well. Goodbye. Goodbye.